the real fundamental driving force for gold is negative real rates, and you can look at negative real yields. I mean, you can look at the real Fed funds rate, or look at the real yield on a 2-year or 5-year Treasury note, and it's quite clear that this is the main fundamental driving force for gold.
The world faces peak gold according to Goldman Sachs, but one geologist who's discovered more than 30 million ounces of gold says he knows where to find America's hidden gold deposits. Featured on the History Channel's How the Earth Was Made, this expert gold finder could be on the verge of a massive gold strike. Even a billion-dollar gold giant has engaged this small market cap company to use their proprietary technology. For the thrill of gold discovery with a new edge in Nevada, visit futuremoneytrends.com/gold.
Hello, everyone, and welcome into CrushTheStreet.com. We got a returning guest today. His name is Jordan Roy-Byrne, and he's with thedailygold.com. He's a chartered market technician, and he's an author of a recent 2015 book, The Coming Renewal of the Gold's secular bull market, which is actually available for free, and we'll have the link for that, and we'll get into a little bit of what the book has to say, and get Jordan's thoughts on the current market at the moment. So Jordan, thanks so much for coming on the show with me today.
Thanks for having me. It's my pleasure.
Jordan, right before the interview we were chatting, and man, I would not have guessed in 2008, with all the money printing and the reaction to the crash, the financial crash of 2008, the economic slowdown that we saw, I wouldn't have guessed that we'd be seeing sub $1,100 gold and sub $14 silver today. I mean, what are your thoughts on what is happening right here, right now in 2016 in the precious metals market?
Well, I mean, I think there's a couple reasons to really simplify it why we had this bear market. Number one, and Jim Rogers talked about it several years ago, and it's something that I came to this realization when I was doing research for my book. Gold just went too far, too fast. And gold in 2011, based on looking at what gold had done historically, some historical analogs, and comparing it to other bull markets that turned into a bubble, gold in 2011, at that point, gold was either going to go parabolic or it was going to have a long bear market / correction. But I mean, it's really a bear market. And I mean, it's easy to say that in hindsight, but looking at charts, gold, it had just gotten to a point where there was potential for it to go parabolic, and if it really did go parabolic and got to $4,000 or $5,000 an ounce, that would have been completely it. So of course it didn't take that route, and it was
What do you mean that would have been completely it? Like, what do you mean by that?
Well, that would have been the end of the secular bull market.
Oh, I see. And then we would have gone into the bear market. But we're in the bear market now. So are we switching over into that what could be a parabolic move ultimately? Like, did we not get that parabolic move you said you're talking about in 2011?
Not quite, because compared to it's difficult for us to talk about it. I mean, it'd be much easier if we were looking at charts, but basically the slope of the, I mean, if you look at gold in 1980, I mean, I think it was in the mid 200s and then it went parabolic. So it almost tripled, I think, in a little over a year. Whereas if you look at what gold did in 2011, I think it was up, I don't know, 50 or 60%. In a maybe like an 8 or 9 month period. I think it had made a low earlier that year at 11 or 1200 thereabouts. So the shape of the parabolic move, it wasn't as steep as what we had seen with gold in the 70s. And also, if you look at the performance, I mean, gold had gone up in that bull market. I think it had gone up about 25 times, whereas this time it was only up 7 or 8-fold. So it was not as much. And even if you look at the inflation-adjusted move, it was still back then. I think the inflation-adjusted move was at least twice as big as it was this time around. But the other reason is the real fundamental driving force for gold is negative real rates, and you can look at negative real yields. I mean, you can look at the real Fed funds rate, or look at the real yield on a 2-year or 5-year Treasury note, and it's quite clear that this is the main fundamental driving force for gold. And
if you wouldn't mind, explain what a real negative yield is, because the nominal yields aren't negative in the States here. But what do you mean by real negative yields?
Right. That's a great question. Basically, you're looking at inflation-adjusted interest rates. So gold typically does really well when inflation-adjusted rates are falling, there's two ways that can happen, basically. If interest rates are going up, but inflation is going up faster, then real rates are going down, because inflation is going up faster than rates are going up. And that's what happened in the 70s. Inflation went up faster than interest rates, and so real rates were negative. They were in negative territory for much of that bull market. And the same thing from 2001 to 2011, where rates, they had gone up at a certain point, and then they had gone down, and basically the inflation adjusted, because when rates went to zero, inflation was, 1 or 2% in late 2008, 2009. So real interest rates were still negative. And the reason is, let's look at where we are now. If based on all the economic statistics, which may not always reflect reality, inflation, I think, is 1 or 2%, and interest rates are 0% or 0.5% or whatever. Now, if interest rates were like 4 or 5 or 6%, there'd be no need for gold, because everybody would say, well, I'm going to put my money in the bank.
Mm-hmm.
Look at where stocks are, look at where these other assets, look at where real estate is. I don't need gold. I can put my money in the bank and make 5 or 6%. And that's what we had in the 80s and the 90s. You put your money in the bank or a short-term bond, you were earning a real positive return on your money. And so essentially what happened in the last, from 2011 to 2015 is rates. The things that I look at, like the real Fed funds and the real 5-year yield, rates were, in 2011, they were -3 or -4%. And those basically went from there to 0 or slightly positive. And so someone would say, well, real rates are still at 0, or they're only, 0.5% or whatever, gold should still be doing well. But the problem is the fundamentals for gold got a lot worse during this period. You'll not hear any gold bug or gold bull say that, but that's just the fact of the matter. The fundamentals in 2011, real rates were -4, -5%, -3%, depending on what you're looking at, and they came down and went to 0 or slightly positive. So that is a negative change. That is the fundamental explanation for why we're in a bear market, why the bear market happened. And even if you look at shadow stats, even if you use that, the rate of inflation has still come down. It was much higher 4 years ago. It's come down. Rates have gone up a little bit. So it doesn't matter whether you look at the government statistics or these other statistics. They show that the fundamentals for gold in the last 4 years have got worse. Now, what I talk about in my book is basically, we have this huge debt problem, and the way to get out of these debt problems is you have to grow your way out of it, but you also need inflation. So it's a combination of inflation plus growth. And inflation is really the easy solution, because if you get inflation, it devalues the burden of the debt. And so that's basically why, even if we do have some kind of recovery in they're able to raise rates a little bit, they're never going to raise rates to what they should be, because that would affect the interest burden. The interest payments would become really high. So that's why in this scenario that we actually have a little bit of a recovery and we can raise rates a little bit, that's not going to be bad for gold, because like in the 70s, what we would see because of the debt situation is they're not going to raise rates high enough. They're going to keep them, they might raise them once or twice. They might keep them artificially low. But basically, if we get inflation, they're going to let the inflation run, because that's how we're going to get out of the debt problem. So that's kind of the fundamental explanation. It all comes back to real interest rates for gold.
Jordan, when it comes to gold, it's easy to get down in terms of U.S. dollars, but around the world, gold is not as bad of an investment in other currencies. I mean, what are we seeing around the world? If you were holding gold versus the yuan, or gold versus the Canadian dollars, or all these different currencies that are just collapsing. I mean, gold is acting as a crisis hedge.
Yeah, well, I mean, you basically have a situation where the dollar in the last couple of years, specifically, the dollar has done really well. It's surged and gone a lot higher, but at the same time, gold has outperformed. I don't have it in front of me, but it's outperformed, most of all the other currencies since the tail end of 2013. I mean, I like to look at what I call gold against foreign currencies, or a foreign currency index. Basically, if you just look at the U.S. dollar in the inverse of that, and you chart gold against the inverse of that, there's an ETF called UDN. That's a simple way to do it. And if you look at that chart, gold divided by UDN, you can see that it made its bottom in late 2013, and it's been slowly trending higher over the last 2 years. And I think gold relative to foreign currencies has definitely bottomed. I mean, it's come off a fair amount in the last 2-3 days, but I think that has bottomed in late 2013. And I mean, that's something I'm going to be keeping my eye on going forward, because typically, and I also talk about this in my book, if you look at history, gold relative to foreign currencies has always bottomed before gold, ahead of major market turning points like 2008, 2001, and the same will be the case in this coming bottom.
Jordan, people don't like to hear it, and I'm not trying to be a cheerleader for the dollar, but is 2016 going to be a year where the dollar continues to get stronger? I mean, is the dollar index going to continue to rise in your assessment in 2016?
Yes. In my assessment, yes. And we obviously can't predict the future, but I think it's more likely than not, looking at everything, that the dollar is going to break out and have a big move higher. And I think a good segue into where we are with precious metals right now. I mean, I think that's really the last problem for precious metals right now, is that the dollar index are trading at about 98 or 99. I think that is going to have an explosive breakout above 100 sometime this year, and that could really coincide with a sort of final decline in precious metals before the end of the bear market. I think like I said, we can't predict the future, but I think that's really the biggest risk for precious metals over the next quarter or so. And looking at the U.S. dollar, looking at the sentiment, I mean, the dollar's been consolidating since about a year ago, and so sentiment was really, really bullish then. It's not bullish anymore. I mean, if you look at the COT, for example, it's just the speculative money betting that the dollar is going to go higher right now compared to a year ago is so much less. So the dollar is really primed for a good breakout. And there was a lot of research coming out in the last couple months about how the dollar it's going to consolidate or sell off during the rate hike, because people are looking at history. But I went back and I looked at the Fed funds rate, and the 2 times that they raised the Fed funds rate after the dollar had already gone up a lot, which was in 1999 and 1983. Well, what happened after those 2 times is the dollar corrected for like a month or two, and then it went a lot higher. So history, technicals, and sentiment, they all tell me that the dollar is going to have a big move higher at some point this year. And like I said, that to me is really the final risk for precious metals. I mean, we know that the long-term value is there. We know that this is a really long bear market that's probably going to end this year. And I think seeing the dollar have a big breakout above 100, the dollar index, I should say, that could be the catalyst for maybe a final sell-off in precious metals. And just the last point, historically, precious metals tend to bottom about 4 or 5 months before the dollar peaks. So I'm not really sure when the dollar peaks, but just as a precious metals bull, I think looking at the dollar index again, it's like at 99 right now. I mean, I'm going to feel much more bullish on precious metals in the immediate term, like when we see the dollar at 110 or 115, because if the dollar is much higher, I know that it'll be closer to its top. But that's just the problem right now for precious metals is the dollar has strong potential to get a lot stronger in the months ahead.
Yeah, no, I guess I'm a little shocked that the collapsing currencies around the world hasn't pushed precious metals higher as people, panic out of their own currencies and they lose their purchasing power. We haven't seen a larger flood over to precious metals and essentially see gold lose less badly to the US dollar because of that influx in demand. And I suppose we have seen more buying for precious metals, and and there's the argument for the manipulation that we're seeing in the markets as well. So Jordan, just in conclusion here, what is your action plan, your strategy? I mean, what is it that you want people to know here and now in 2016 going forward?
Well, I think right now we're really starting to see the transition from a bear market to a bull market in precious metals. I mean, it's a long process that could take more than a year, and I think we've already started it. But we're not quite at the point where a bull market has started yet. And to go back to what you said, I mean, if you look at gold has done, I mean, it has lost less badly, as we were talking about before. Like if you look at the price of gold in Canada and Australia, it's actually doing really well. It's, I mean, relatively speaking, it's like at 14 or 1500. So companies in those locations, they're doing a lot better. They're doing fine. And if you look at like charts of Aussie miners and Canadian stocks, I mean, they're actually doing fine in their own currencies. But the problem as American investors is, a Canadian dollar chart of a certain miner, that might be doing okay, but, that might go up 10%. But if the dollar is up 20%, then that means you lost 10% if you're a U.S. investor. Mm-hmm. So, I mean, it really comes back to the U.S. dollar strength, and that's really the last problem. But another thing I'd like to mention, if you look at, I put out an article last week, we didn't really get to talk about the stock market in this interview, but one reason why gold hasn't done as well in the last couple years, as you were saying, is I think stock markets around the world have been strong. So people around the world, they can see, well, our currency's going down, but the dollar's doing well. I want to put my money in U.S. stocks or European stocks or whatever. And that hedge, so to speak, has been able to work for them. But that global markets are rolling over, they're breaking down, the U.S. market's rolling over. And if you look at gold against U.S. stocks or gold against global stocks, I'm calling a bottom in that ratio. I called a bottom last week. So that relationship, gold against global equities, I think has bottomed. That doesn't mean gold is going to surge and outperform immediately. But looking at the chart, I just think over the next couple of quarters and for this year, we're going to see a transition where gold is going to start to outperform global equities. And that's something that, I mean, like I was talking about, leading indicators for major bottoms. I mean, we saw that in 2008, where, remember, gold during the financial crisis held up really well. It held up well in foreign currencies. It did not go down as much as the stock market did. And that kind of relative strength preceded the new bull market. And so we're kind of seeing that relative strength now with gold against global stocks. That's bottoming. Gold against foreign currencies, I mean, that's holding up okay. So these are all very good signs for gold, but it doesn't mean we're going to bottom, today, tomorrow, or the next month. I just think coming back to the dollar, I mean, look, that's the real X factor. And, until the dollar gets really overbought again and close to an important top, we're not going to see, precious metals start a new bull market. So I think waiting for the dollar to break out and get a lot stronger, when that happens, I think we're going to be much closer to a new bull market starting in precious metals. And that's the time when you want to start putting more money to work. I mean, as for now, it's fine to hold positions, but think about hedging those positions, because there is a risk that we could see one more leg down in precious metals in the months ahead. And I wouldn't want people to lose more money based off that move. It's easy to just put a hedge or two on and have your portfolio be protected.
Jordan, I tend to agree with you. I tend to think the dollar is going to get stronger here in 2016, especially if markets melt down. And I don't know how gold exactly will react. I'm optimistic that people will go to gold as an investment, as a crisis hedge, and I feel like that investment demand can send gold higher. But you're right, if the dollar gets stronger, that'll be headwinds against gold. So if you could just tell everyone a little more about what they would find if they visit you at thedailygold.com, we'll close there.
Yeah, well, thanks, Kenneth. If they go to thedailygold.com, all my free work is there. I have a premium newsletter. But first, sign up for my free newsletter. There should be a opt-in box on the front page. And if you do that, you'll get my book for free. And I'm also doing a January update that should be out in the next couple of weeks. You can also go to thedailygold.com/book. You can also sign up for my newsletter there and get the book for free. That's a little advertisement for my book. All my work you can see for free is at thedailygold.com. And if you have any comments or questions, feel free to email me, jordan@thedailygold.com.
Jordan, thanks so much for coming on once again and sharing with us your research, your knowledge, and just kind of giving us an idea of what to expect here in 2016. I really do appreciate it.
Thanks for having me.